Awesome. We've just got the recording started here for the market update. We'll wait another minute or two for people to join in. Hey, hey. What's up, Rab, Manny, John, Susan? Everyone having a good Monday? It's a holiday here in the U.S., technically, kind of. President's Day. It's kind of a BS holiday, to be honest. But they close the markets for it. So, I guess it counts. I kind of envy y'all in the crypto space who get to trade 24/7.
It's a blessing and a curse.
Yeah, that's right. Crypto's moving today, huh? Last day or two. It's exciting. Getting a little pop. All right. Should we go ahead and get started? So we've got our stock weekly update here, February 18th, 2019. The markets are still rumbling, still trucking along. So we had another good week last week in the markets. The S&P 500 was up about 2.5%. NASDAQ as well, similar levels. So those are both up around 12% year to date now. And the earnings reports that have been coming out last week looked overall relatively good. There were a few misses and a few home runs, but overall the earnings reports still look pretty good for Q4. So that's really driving the market. And then we've got real improvements in what's happening on the trade talk front, allegedly anyway. So that continues to push forward with positive news flow. And there was really not a whole lot happening on the macro front that looks too scary at this point. Rates were about flattish last week. Crude was up about 4.5%, so it reversed or it actually continues the strength that it's had for the last couple of weeks. And the inflation data that came out on the macro side was pretty benign. That was one of the big economic reports we were looking for out of the U.S. And the inflation data, I'm going to go ahead and pull that up for you to show you how that's trending. So let's just pull it up here. Well, how about let's do this? This will make it easier. It's always hard to pull up the right one when I'm on the spot. So the inflation rate, came out 1.6%. So it's been decelerating. This was what the Fed was worried about last year, mid to late last year. That's why they were raising rates so quickly. And actually, the rate increases have done their job, and the inflation rates are really benign. Less than 2%. This was a pretty good 1.5% inflation number. The Fed is pretty comfortable with, call it 2.5% inflation. I believe that's right in line with their target. So this is actually a little bit below trend and below where they like it to be. So yeah, this would support, them being steady on rates. And so the market, that was another thing that the market liked last week and help push the market up. So, there's, in terms of what we're watching going forward, we're gonna continue to hear actually quite a bit of stuff from the Fed this week and next. There's a number of Fed governors that are talking, and we don't have a ton of macro data coming out, but there are some early release PMI data that gets released and durable goods orders. But yeah, the FOMC meetings come out on Wednesday, and then we get some Fed speeches this week, like I mentioned. So we'll be watching that. But again, I don't expect anything really major on those fronts. So, it's really kind of, it's smooth sailing, it looks like, for the near term for markets, unless some more geopolitical concerns flare up globally. It could be a nice couple of months here as we lead into spring for the markets in general. So, Other things that I'm watching, we had a couple earnings reports last week from a couple of our companies. There was nothing really actionable. We had Criteo and Huntsman. Criteo's guidance was pretty meh for me as far as 2019. They're expecting to grow between 3% and 6%, and that's not bad. So we do like that Criteo is growing again. The reason the stock was down so much last year was fears of the business having a longer term threat to its growth. And so if we look at these longer term, let's not do that. If we look at this longer term chart, you can see that this stock was a $40 stock, $40 stock until some of the news around the ITP tracking from Apple came out and the GDPR regulations came out. So we do expect that this should be able to march back up over time, back into those $40, $50 potential levels if the company continues to execute, especially with its new products that it's working on. So one of the things, I think we've talked about it a little bit, but one of the things that I'm excited about for them is they're doing a lot of this sponsored results. So if you ever go to Amazon and you're let's say you're looking for an office chair, right? And you type in office chair and you come in here and you see all these sponsored results up top, right? They don't necessarily look like they're sponsored, but you can see here this is an advertisement. So there are companies that are paying to be the top results on the page, just like companies pay to be on the top of Google search results. So this business for Amazon has been growing really rapidly over the last few years, and it's it's a several $billion revenue business for Amazon. And in fact, even these are sponsored results here. So the first part of the entire page is sponsored results now. So it's interesting to see how that's changed over time with Amazon. And these are your actual first organic results you have to scroll down to. Now, Criteo wants to do the same thing. They want to enable other companies besides Amazon to be able to offer this on their website, right? So, we've been talking about Overstock, but, potentially they would do something like that, right? You search for an office chair on Overstock, and I'm just going to close that out. So enabling other retailers to offer sponsored results on their pages is one of the products that Criteo is working on. So I'm pretty excited to see if they can drive that. Imagine all the other retailers besides Amazon that could benefit from having sponsored results on their pages. And Criteo wants to enable the technology to connect basically for advertisers to be able to advertise sponsored results on lots of different websites. And not every website wants to build their own sponsored ad engine. And so Criteo wants to offer the engine so that both publishers like e-com sites such as Overstock can offer those sponsored boxes. And then on the other end, on the advertiser side, advertisers can bid to put their ads inside those sponsored boxes. So that's one of the products that I'm excited about for Criteo. And it's not really showing up in their near-term growth expectations. I mean, they expect to grow a little bit this year, but really that's probably a story for the next 2, 3, 4 years. So that's really why I've been watching the stock and why I liked it, really around $20 a share. I think it gets pretty compelling. So nothing really exciting out of the earnings reports. Same thing with Huntsman. That's another one on our list. Chemicals company, you can see their Q4 numbers actually, their 2018 numbers showed really nice growth over the prior year, but 2018, the fourth quarter was a little bit flat in terms of revenue. So they saw some deceleration really in the polyurethanes business, which is sensitive to a lot of electronics production. And so as you can imagine, as China really weakened a lot and some of the global semiconductor destocking happened, the revenue growth rates and the earnings growth for Huntsman really slowed down in the fourth quarter. So it'll be interesting to see how their numbers develop for 2019. I would love to be able to see a recovery in the numbers at Huntsman and them continue to get back to growth. They didn't give specific guidance here in this release, but they did say 2019 will be another year of strong free cash flow generation and growth in our downstream businesses. So there is some expectation of growth for 2019, and the stock still trades for like 8 times earnings. So it's a pretty cheap stock, and if they can grow this year, that could be a nice winner. We can pull up the chart here and show you what it's done in the last few months, but it's you know, it really took a pretty big hit back in the fall time frame, like a lot of stocks did, but hasn't had a huge rally like some of the other ones, but it has rallied off the bottom here. So we'll be watching that, and there could be potential for a trade there later in the year. So other than that, NVIDIA reported, but again, largely it had already built the low expectations into the stock because, they had pre-announced this ugly, this is the gap down that happened here when they pre-announced their revenue was going to decline quite a bit after years of having grown revenue really nicely. And so on the earnings report, there wasn't a lot of new news, and the forward guidance wasn't as bad as people expected. So there was a little bit of improvement here in the share price in the last couple of weeks. So that was NVIDIA. And someone had asked about Under Armour. Now, this is a stock that isn't on our watch list per se, but it is one that I've watched over the last few years. And, Under Armour is a stock that I really want to like more. And it's their 2019 outlook, though, puts in perspective exactly why I can't quite get excited about the stock yet. It's, revenue growth expected to grow 3 to 4%. And that's fine. But for a company like Under Armour that should be growing really rapidly, especially internationally, they just don't seem to be executing well. And let me just give you a little bit of context. So Under Armour, they were growing, as you might expect, a fast-growing brand that's taking market share in the athletic apparel industry. They were growing at 20 to 30% a year for many years. And then all of a sudden, 2017 hit, and they were almost flat. They barely grew in 2017. So far through in 2018 as well, they were growing mid-single digits. And so the fourth quarter numbers showed that they were growing, very, very low growth rates. While if you look at a company like Nike, let's look at Nike's growth rates. So Nike's growth rates, and by the way, this is a spreadsheet that I have just to punch in that pulls in numbers quickly whenever I punch in a ticker here. So if I punch in Under Armour, I can pull up their quarterly numbers really quickly, and it pulls all the financials in. And right now I'm using a company called Tagnify, but there's another company called Intrinio that I'm looking at using. So I build these templates, and I can pull in a bunch of different numbers from the financial statements for these companies right away. So if you look at Under Armour, this is the year-over-year growth rates for the last few quarters. 4, maybe 6, 7, then decelerated back down to 2%. Now, if you look at Nike is 10 times as large. And a company that's that much larger usually sees much, much slower growth rates than a smaller company. Smaller companies can typically grow much faster than a large company. And a lot of that has to do with the law of large numbers, but it also has to do with, the amount of the market that it already controls. When you control, 60% of a market, it's hard to grow quickly unless that end market is growing very fast. So, but Nike, it's interesting. Nike's much, much larger than Under Armour, but it's growing faster than Under Armour. So it's growing double digit, or close to double digits year over year. And if we look at, the share price performance, it's reflected. Nike has over $100 billion of enterprise value now. And, if you look at a 5-year chart, like the stock's doubled basically over the last, in fact, it's almost tripled over the last 5 years. And if we look at Under Armour, and we look at a 5-year chart of Under Armour's basically down 50%. And so, Under Armour, it's like, it should theoretically be able to grow faster than Nike, and it should be able to catch up ground in terms of its market cap and enterprise value, right? I mean, let's look at Under Armour's enterprise value here. I think it's just under 10 billion of enterprise value for Under Armour. And if we look at Nike's, we'll get an exact figure. I know it's over 100 billion. Yeah, in fact, Nike's enterprise value is about 135 billion today. So, you've got Nike that's much, much larger, growing much, much faster. Under Armour, I would love to see Under Armour start to execute well, grow faster. Could Under Armour become a $20 billion or $30 billion enterprise value company? Can the share double or triple or quadruple even in the next 5 years? I mean, I think the underlying conditions are there for them. They just can't seem to do the right things to make that happen. And maybe, honestly, maybe they need a new CEO. I mean, the founder, Kevin Plank, right? It's a great story about how Under Armour started, right? University of Maryland guy, Kevin Plank. They come out with the compression gear, and he's basically manufacturing these things in his basement. And to his credit, he's built a $10 billion company, and very few people can say that they've done that. But I think the next phase of the company, if they want to become the next Nike, if they want to grow to be a 30, 40, $50 billion company, maybe Kevin Plank needs to step down and hand the reins over to someone who knows how to execute with a company this large. So that's my take on Under Armour for now. I'm going to continue to watch it. I would love to see if they can start to do the right things on the merchandising side and accelerate revenue growth. I mean, 3 to 4% is just not doing it for me. If they can do that, then I would get much more interested in buying a stock like Under Armour. So yeah, their report last week was disappointing again, and that's another one in the string of disappointments for me for Under Armour. So anyway, hopefully that gives you a little context about how I'm thinking about something like that. In terms of earnings reports this week, I know that Nikki's owned Walmart for a while, and a lot of people pay attention to Walmart because they're such a large global retailer, and they report on, I believe, tomorrow on Tuesday. So that will be a big bellwether report for earnings. And we'll be watching that one and reading into what kind of economic, outlook Walmart sort of offers, because they can be a bellwether for the broader consumer. So we'll be looking at that report when it comes out. Devon Energy, which we mentioned last week, it's on our watch list. This stock has had a pretty nice run in the last few days as oil's up, right? It was up a couple bucks. So, it's not really in buy range for us at the moment, but it's a very well-managed company. It's basically been up the last 5-6 trading days. So it's running away from us, but we're going to watch the report and look at that and see what's happening with Devon. CVS reports on Wednesday, HP on Thursday, Roku on Thursday. We've been watching Roku. It's sort of run away from us as well. I think it's getting into frothy territory up here. Now their fundamentals are really, really strong right now. I think their report's going to come out really, really strong, but that may be baked into the stock already here as it's run quite a bit. It's over 60, 70% in the last 2 months. So, but I will be looking at the Roku report on Thursday. And then Dropbox, we get after the market close on Thursday. So Dropbox is a big one that I'll be looking for. So I promised you all that I was going to show you how an example model for how I determine a share price. And I'm going to show you that a little bit here in a little bit on the weekly update. I've got the Dropbox model to show you and give you a little bit of info on how or what I'm looking for in terms of info on their earnings call and their earnings report. So we'll tackle that here in a minute. So that's Dropbox on Thursday, earnings report on Friday, Wayfair and AutoNation. AutoNation's one that I've been watching. It's a really cheap stock. And, I had tweeted about a couple months ago. I was starting to get pretty interested as it dropped below $40 a share. It trades for about 8 times earnings, trailing earnings. Now I'm a little concerned about the auto sector in general, especially these auto retailers. AutoNation and a lot of the traditional automotive retailers have been getting somewhat disrupted online as more and more people move to searching for information about cars and used cars and even buying new cars online. Companies like Carvana and there's a bunch of them, right? Like let's just search like a, Toyota Camry, right? You can see that there's a bunch of competitors now in this space. Car Gurus is another one. They're a public company now. You've got Edmunds and of course CarMax and a lot of the other ones. But there's basically been a lot of new entrants, Car Gurus and Carvana and a few others like that have been disrupting a lot of the traditional players online. So they're losing some share there. And TrueCar is another one. TrueCar is another public company that's doing some interesting things in that space. So I'm a little concerned. I'm going to wait on AutoNation to do anything. I want to see more data on what the fundamental picture looks like for them for 2019 and going forward. So, but they do report on Friday. Like I said, Wayfair also reports on Friday. Wayfair is an interesting one. This stock is so expensive. It's been a high flyer. If you look since the IPO, it's done extraordinarily well, and they've taken a lot of share, especially in the household good e-commerce sector. So, but the thing about Wayfair is it's just, it's so expensive on a price to sales basis. most large good retailers trade for somewhere between like 0.5 and 2.5 times sales, and I think they trade for like 5 times forward sales or something pretty crazy. So actually, let's pull it up because I don't I don't know the exact figure. I looked a while back, but let's look. So if these numbers are right, and I do have to check because Rocket Financial isn't always right, but their EV looks like 11 billion. And let's see if we look at their trailing 12 sales, they're doing, okay, it's not as bad as I thought. Okay, so they're doing about 6 billion. So they're trading about 2 times trailing price to sales. If these numbers are right, I'm going to go ahead and pull up my sheet and we'll punch this in on our spreadsheet as well and see if we can get confirmation that those numbers are at least in the ballpark of where we think they should be. These things are kind of slow. They are pulling in a lot of data. So yeah, about 11 billion enterprise value. That looks right. And then, about 6.2 in last 12 months, 6.2 billion in sales. So it's actually not as high as I thought. For some reason, I thought it was trading for like 4 or 5 times sales, but it's not. So that's not quite as overvalued as I thought it was. But Wayfair is interesting because I know that there's pretty strong bull and bear arguments on the stock. So that one's interesting. And Wayfair is a competitor of Overstock for Overstock's retail business, and Overstock trades for a fraction of trailing 12 sales. So Wayfair gets quite the premium, whereas Overstock gets quite the discount in terms of its price to sales ratio. But other things that we're looking for this week, there's a couple conferences. There's a big consumer conference called CAGNY. So Canopy Growth, if you're following the weed stocks, CGC, it will probably have some comments from that conference. So that stock's been a high flyer. So that conference, if there's comments there on Canopy, you could have some stock movement from that conference. Other things related to our watch list, I talked about Fannie Mae preferred stocks. I'm not quite ready to give a deep dive on this yet. It's a pretty complex situation, and I'm still working my research, and I'm still putting things together. But I do think, again, this is a preferred stocks trading somewhere between $8 and $9, depending on the issue, and it could be, I still think the most likely outcome when these things get reprivatized is for these preferred stocks to go to somewhere between 20 and 25 a share. Now, it's going to take a couple of years to get there, probably at least, 1.5 to 2 years. But I do think that offers some nice upside. And there is a small probability that I think that this could have upside to $100 a share. So again, I think it could be a 10-bagger in my very bullish case. I don't put a high probability on that, but when I was reviewing some of the particulars of the situation, which again I'll talk more about probably on the next weekly update, there is a possibility, and not a totally far-fetched possibility, that this could, in the right scenario, be $100 a share in a couple of years. So anyway, there's a lot of things that have to happen before now and then, but that even just having a small probability on that potential 10-bagger case definitely led me to get a little bit more aggressive on the preferred shares. And so I added a bit more to my position here. So that will be one that I'm watching closely. There are a lot of potential news headlines legislatively or even from just talks with the new FHFA director, who I believe, Mark Calabria is the new proposed FHFA director, and there's talk that he could be sworn in, or there could be a vote on his appointment as soon as next week. So we'll be watching that. And he is supposed to be he's a positive catalyst for the reprivatization of these entities. So that will be a positive for these preferred stocks as well as the common stock if he is successfully appointed. And that right now does look to be a pretty good chance. There's a pretty good chance of that happening based on, there was a congressional hearing last week with Calabria where they interviewed him, and there were senators from both sides of the aisle asking questions, good questions. And by all accounts, he seemed to answer most things pretty admirably. He's not really a controversial appointee like some other Trump appointees have been. So it is expected that he could get appointed in the next couple of weeks. So, and this is the common stock, and we we'll be watching what happens in this situation over the next few weeks and months. So that's it on what we're focusing on this week and our watch list. I'll talk a little bit more again, like I said, about Dropbox. So, Dropbox reports on Thursday after the close, and I've been putting together my model on Dropbox, and there's a lot of pieces to this. We're not going to go over every single line of this today, but this is what a basic financial model looks like, and this is a pretty simplified model. But these numbers for 2018 are estimated because we don't have the full fourth quarter numbers, or we won't until Thursday at least. So we have the first 9 months, and then I'm estimating for Q4, and they've given guidance for Q4. That's actually what I have here in this guidance tab. You can see that they gave guidance for a range of revenue from 367 million to 370 million, or 370 million on the high end. And they've also given estimates for the non-GAAP operating income margin, or what we call EBIT, earnings before interest and taxes. So we have those that they've given already for Q4, and then they have the guidance for the full year of 2018, which again is already pretty much over. But that's where these numbers come from. Generally, I find the midpoint number by just taking an average of the low and the high end. But this gives us a really quick look at where's the guidance for Q4 18. So when they report, I'm going to go in here and I'm going to look at those numbers that they report relative to these guidance ranges. And these numbers here, they're probably going to give guidance for at least Q1 of 2019 on Thursday. They may even give some guidance for the full year of 2019 on Thursday. So these are my estimates of what their guidance will be right now for 2019. I'll adjust these as soon as they give or don't give guidance on Thursday for parts of 2019. But you can see here, I'm making an estimate of what I think the margins are going to be, what I think the revenue is going to be. And we'll adjust these to look at their guidance. But if they report any numbers that are like far outside of these ranges, both for the forward guidance for 2019 or for the relative to the guidance that they already gave for Q4, then there may be something to do with updating our model or even trading the shares. So if they're far out of these ranges, then we're going to have to update our assumptions about what we believe the numbers in the business could or should be. So. And here's another tab, revenue drivers tab. And you can see, if you think about revenue, revenue is really a function of how many paying users they have and their average revenue per user. And so they thankfully give us pretty good numbers in terms of these user metrics. Every quarter they report their paying users at the end of the quarter. So that's why you see this paying users end of period line. And so I've already got an estimate in there for Q4. Again, I'm gonna look at their release and compare it and see how these numbers compare. And actually, here we can back into what we believe the average revenue per user. Now we have to use the average number of these paying users figures. So, and actually we have to annualize the revenue. So we'll divide that by 90 days and then multiply that by 365, or we could just multiply by 4. That'd be roughly the same. So we're looking for about 120 of ARPU reported for Q4 and about 12.7 million paying users. If they're far off of that number, then there's going to be a big reaction in the stock one way or the other. So it'll be important to watch those numbers. But these numbers also help us derive what we believe the revenue number will be for 2019, 2020, 2021, and the next few years going forward, right? So we can make assumptions about what the growth rates year over year look like for their number of paying users for their service, and then what the average revenue for each user is, right? Because they over time add products, they raise their prices. So you've got two levers to increasing revenue growth here. You've got growing the number of paid users as well as the price per paid user, right? So if we model these two numbers will essentially give us what our revenue growth or what our revenue is. And then we can look at what that means in terms of revenue growth year over year. So those numbers, right, what we choose to assume that looks like, and I actually have paid user growth decelerating over time, which it has been doing already. It was, mid-20s growth and decelerating down to about 18%. I'm actually only giving them, at least in this case, I'm only giving them credit for about 12.5% paid user growth next year, and about 5% increase in average prices. So that's how I'm modeling it in my base case for these next couple of years. And what that means is revenue growth decelerating from about 21% next year to about 13% by 2022. So that's actually where I derive my assumptions here for my revenue growth. And I actually have three cases here. I have a bear case, which is like, if things don't go well for them, if they don't execute well, what do the numbers look like? And the revenue growth rates are actually much lower. Now, again, you saw my base case. So that's about 20% revenue growth next year, decelerating to about 12.5% 4 years from now. And then I also have a bull case, which is like, what if they're able to reaccelerate revenue, or they're able to at least not decelerate as fast, which is what's happening here, and maintain pretty high, pretty nice mid-teens to low 20s revenue growth rates for the next several years. And then, you can see I do the same thing. I have three different cases of assumptions for their operating income margins. So their operating income margins, I expect to, almost no matter what, except in the bear case, I expect them to improve over the next few years. And there's a couple of reasons for that. One of the reasons is that I expect the depreciation and amortization line on their income statement, I actually expect D&A to go down. D&A is a non-cash expense. It's an accounting expense, but it's been pretty elevated for them recently. And I expect that to decline over the next few years, although it will be high again next year because of they're going to be amortizing some of the intangibles related to the HelloSign acquisition, which we'll talk about in a minute. Anyway, not to get too in the weeds here, but basically that's one reason I expect operating margins to grow. The other reason I expect, and the main reason I expect operating margins to grow is that, as they increase revenue, they have really high margins on incremental revenue. So every new dollar that they take in, a lot of their expenses are fixed, right? They're already paying for data centers, and they're already paying for their marketing team. They're already paying their executive salaries. So every new dollar of revenue that comes in should drop to the bottom line and be, it should drop more to income than previous dollars did because they're getting fixed cost leverage. So, they have high gross margins. Their gross margins are over 75%. So, as long as they keep their fixed overhead expenses, from growing too quickly, then I expect as revenue grows, their margins should expand. So what that means is, more or less what you have is free cash flow, growing from, call it around 350 million this past year to potentially around 500 million 4 years from now. So that's pretty nice growth in free cash flow. Now we can ignore all this balance sheet stuff that I do. That all gets fairly complicated, and we'll cover some of that we'll cover all of that in the bootcamp course so that you can understand it. But for now, it's not that important. Here you have the fully diluted share count. So that will grow over the next couple of years. We will get some dilution from options, management options, and employee options, but that's factored in. And then so all those assumptions give us the free cash flow, and then we determine. We also have assumptions about what we believe the market is going to give in terms of a free cash flow multiple. And I have three different ways that I value the shares. I value them using an EBITDA multiple method, which I don't think is that appropriate in this case. And then I also value it using what I call the levered free cash flow multiple, which is a pretty typical way to value the business. And then I have a different method called the no growth free cash flow multiple, which basically is a way to smooth out some of the near-term capital spending that they're doing that may be for future growth, because in the future they may be able to run the business as a cash machine. They may be able to not have to spend as much on capital because they'll be in a more of a steady state, if you will. And so this is more like steady state free cash flow, where working capital changes and capital expenditures normalize. And so that's technically this third method. And so, I have a range of share prices. You can see the expected share price for each year under each method. And then I actually average those out. So you can see in my base case, I have this thing here called a switch or a case switch, which allows me to change to, if I hit 1, then we essentially the model is using all of the bear case assumptions. And again, if I hit 2, then we're using our base case assumptions, and that's what the model's spitting out. And then 3 is the bull case, right? When things are going, when they're hitting on all cylinders and things are going right for them, then it's using all the bull case assumptions. And so you can see the share price ranges that we have under each set of assumptions. And by the way, none of this is incorporating the new HelloSign acquisition. So we don't have a lot of information yet on the impact that HelloSign is expected to give them, either in terms of revenue or lift in ARPU or number of subscribers or anything like that. So we're going to be really looking for guidance on HelloSign revenue and HelloSign's forward impact. It is interesting to note that HelloSign's largest competitor, DocuSign, they're doing about $700 million of annual revenue and growing that at about 35% year over year. And they have a really high 83% subscription gross margin level right now. So my guess is HelloSign is much, much smaller today. They're probably somewhere in the range of like 25 or 30 million of annual revenue. But I do believe even with reasonable assumptions, Dropbox could grow that to $100 million of revenue or more by like 2021 or 2022. And that would potentially add maybe $25 to $30 million of incremental free cash flow. So, when you give that a multiple of, let's say, 25 or 30x, you could be looking at several dollars a share of added value from HelloSign easily. I mean, I think you could make a pretty good case for about $5 a share of potential added value on top of these share price targets. So, if we believe that the share price of Dropbox should be worth $40 a year or two from now, with the right HelloSign impact, we could be looking at a $45 stock potentially in our bull case. And then our base case, maybe 35 or so, and that's increasing over time as well. So yeah, that's why I think the level that I believe is fair value is probably somewhere between $35 and $40 a share, and it could easily go past that if things start going well and the market gives them like a really fat multiple like it does for high growth stocks. But for now, I think the fair value is probably somewhere in that $35 to $40 range, based on how I'm modeling it today. Now, again, we're going to compare what's happening in the actual financial reports to these numbers that we've modeled, and we may have to make changes and update our model. But today, that's how we're thinking about it. And I'm really going to be, like I said, paying attention to what they say about the HelloSign acquisition in the conference call, but also in the annual filing, they're going to have to give us some information on the HelloSign acquisition in terms of financials, most likely. So we'll be able to see some of the numbers, but that will be interesting. And the other things I'll be looking for is, their outlook on their operating margins. Again, like I said, I have pretty nice expected improvement in their operating margins in my base and bull cases over time. So if that's not the case, then that would be a significant detriment to our modeled prices. So I'll be paying attention to what management says about their margin outlook going forward. And also things like the share count growth and how they plan to use cash and how much they want to spend on CapEx this year. I'm modeling out about 72 million of capital expenditures next year. They spent about, or they should be spending about 65 million this year, and that includes actually some additions to their new headquarters. So, I'm modeling 72, which is conservative. It's possible their CapEx number could come in a little lower, and that would actually make their levered free cash flow even higher, potentially as high as like 400 million next year. So anyway, these are some of the things that I'm going to be paying attention to and updating in the model. Hopefully this is useful. I know it's a little bit dense to think about all this, in this weekly update, but I'm just trying to give you all an idea of how some of this modeling works. So yeah, that's Dropbox. It'll be interesting to see. I'll be posting on Thursday after I've looked at the numbers and listened to the call, what I think of everything for Q4. And that's pretty much it. Yeah, so you asked if Dropbox will report at 4 Eastern. Yeah, I think that's about right. It's probably a couple minutes after that, but then have to spend a few minutes looking at the press release, but I'll definitely be in the channel around then to update you all within a few minutes of the press release. Apollo is asking about Coca-Cola. So yeah, what's your question specifically on good old Coca-Cola? KO, ticker symbol KO. Looks like it took a dump here in the last few days. Looks like actually it was off about 10%. My guess is, yeah, did they report earnings? I mean, let's see. We can look it up. Alpha is also always a nice quick look at what's going on, or we can just go directly to their investor relations site. Yeah, so it looks like they reported earnings because they've got an earnings call transcript here from Thursday. So yeah, some of the reports look like cautious outlook. I know the soda business has been relatively weak, right? Like there's been a shift to people drinking less soda, at least in the developed countries. Now Coca-Cola continues to be able to raise prices, which offsets some of the volume declines, and they also continue to grow internationally. So I know that that's helped them, but offset some of the volume declines. But yeah, so it looks like their 2019 outlook sounds like it was a little light, a little cautious. We could dig into that a little further. For instance, you could go in here and listen to the earnings call or read the earnings call transcript, which I always like to do. And we can look at, I can even do a control F here and, see what they're saying about 2019. And yeah, it sounds like they're still growing their revenues, but let's see if we can find their 2019 guidance. Okay, so at a high level, we expect 4% organic revenue growth, double-digit comparable currency neutral operating income growth, comparable EPS to range from +1 to -1, and free cash flow at least $6 billion. So this doesn't look terrible, but who knows what the expectations were that were already built into the stock. People may have been expecting 15 or 20% operating income growth. But again, they are double digit. I mean, we can pull up some numbers here in our spreadsheet as well. Let's just take a look. We'll pull up their recent numbers. Loading. And they may have divested something. This is funky. So this kind of thing is like why templates aren't always like the best thing to use, right? Because, I was just reading that they expect organic sales growth again, but here I have this number that's showing like revenue declining. So there may be something funky happening with the numbers, or they may have sold off. I'm going to look at the quarterly numbers as well. They may have sold off a business. I have not looked at Coke in really ever, at least deeply. Yeah, so the revenue's declining. We could pull up, if we go into, as you all know, I love using BAMSEC for looking at the actual filings of a company. So their last quarter, so they reported Q4, and they're with Q4, their 10K annual filing will show the full year as well as Q4, but that won't be out probably for another month or two. So right now, as far as SEC filings, we only have Q3 is the most recent. We could look up, they probably do have some financials in the press release for Q4 as well. But yeah, so it does look like revenue is down, but we probably could look at the segment. They probably report some kind of segment. Yeah, operating segments. Yeah. Let's just look. Yeah, I'll have to follow up. Yeah, here's the operating segment section in their quarterly. So you can see when you drill down to these operating segments, you can often sometimes see more granularly what's happening in this case, they report regions. So you can often see. So this, like, for instance, this top part shows you the 3 months ended for their Q3, and then this part shows the same 3 months for 2017. So you can kind of compare like operating revenues. Yeah, I mean, it looks like North America is really where they're losing revenue. So, and look, so here's the big revenue decline though. So obviously North America we see is down. No, I'm sorry, revenue is up. Yeah, revenue's still up even in North America. Here's where the revenue decline is happening. They reported 2.4 billion of revenue last year in Q3, and then this year only 900 in their bottling segment. So my guess is they sold off part of their bottling infrastructure. So that's why their revenue looks like it's down, even though the way that they're reporting it is probably apples to apples. And um, anyway, that's a long-winded thing, but I'll have to dig into this some more. Obviously, it looks like their earnings report was a little bit of a disappointment to at least market expectations of what they wanted 2019 to look like. And on a valuation basis, we can look here. It looks like Coke has a $220 billion enterprise value even after the recent decline. Yeah, and it's not super cheap. It trades for over 20 times enterprise value to EBITDA. They're levered. They have a decent amount of debt on the balance sheet, so their net debt to EBITDA looks like it's about 2.5 or just over 2.5. And then we'll have to look at their pro forma earnings, but their EBITDA is about 10 billion. So it's not like, it doesn't look like a super cheap stock, but obviously it's kind of amazing to me that they continue to be able to grow revenues in North America when I know like volumes are either flat or down at least in the soda part of their business. And I know they've been trying to add things like they own Dasani water, and they're probably in the sparkling water game too, because that business is doing really well. But the soda business is not a business I don't think I would really want to be in right now, at least not in North America. Any other questions hot on your mind right now? Feel free to dump some stuff here in chat or Q&A if you want me to take a look at something. SENS. Sense? Is that a stock? I don't know that one, I don't think. Is it this? Senseonics Holdings? Yeah, I don't know this. What do they do? Is it, let's take a look. Senseonics. Let's see if they have an investor presentation or something. Yeah, I don't think I've ever, let's pull up some numbers, see what they look like. Wait for that to pull up. And a med tech company focused on glucose monitoring systems. Okay. And it looks like a pretty small market cap, maybe about a 300 million enterprise value, 400 million market cap, more or less, if these numbers are right, which, so very little revenue right now. Maybe, is it development stage? It may be, looks like they're just starting to earn some revenues. So, yeah, was this a recent IPO? It may have also been. We can check their filings and see. Senseonics. Yeah, they trade on the Amex exchange, which tends to be American Stock Exchange. Amex is smaller companies. There is. I always hesitate a little bit when I see the Amex because there is a lot more frauds on the Amex than other exchanges in the U.S. But other than over the counter, obviously, is where even more frauds live. But Amex has some shady stuff going on sometimes. So this, it looks like actually they've been public for a while because they've been filing quarterly and annual filings since at least 2014. But maybe just now generating some revenue, it appears. So, our numbers, let's see. Yeah, looks like generating increasing amounts of revenue this year. So they're selling something. Yeah, this is one I'd have to dig into. There's probably a lot behind this story that I'd have to dig into. I was hoping they would have an investor report, like a investor presentation here. I'm not seeing anything. It's a pretty thin investor relations section here on their website. So, oh wait, maybe they do have a presentation here. Let's look. Yeah, from August at the Canaccord Growth Conference they presented. So that's where this presentation is from. So yeah, they've got they're in glucose monitoring. They call it out as a $4 billion market. Interesting. So calling out the fact that a lot of people stop doing glucose monitoring within a year because it looks like they have problems with it, which doesn't shock me. And so they want to increase the use of glucose monitoring. So they've got sensors and transmitters and a mobile app. Interesting. They've got some kind of a system, 90-day system, 180-day system. So, okay, it looks like, and so this is pretty typical. They may be commercializing this first in Europe. I mean, as some of you know, the FDA processes for getting approved, or getting medical devices or drugs getting approved for sale in the US can be pretty cumbersome. And a lot of times companies will actually start in Europe because some of the compliance there can be a little bit easier. Now, yeah, so it looks like they've got some sort of agreement with Roche, which is a very legit large player. So that's good to see. We'd have to dig into the agreement with Roche, and that would be interesting to read, what that agreement is like and what the economics look like. But if that is a legitimate partnership, then that's interesting. And then someone called Rubin Medical, I don't know them, but yeah, so interesting, it's interesting to see their revenue ramping up a little bit, and then they definitely look like they're trying to ready for a US launch, or maybe they have already gotten what they need for their commercial launch, and now they're just in the phase of figuring out their go-to-market strategy. Interesting. Yes, this is going to be one of those that's probably a little bit hard to analyze. You've got to make some pretty aggressive projections and assumptions that about their future market potential and future revenue growth, and what their TAM, what their total addressable market looks like, and what they're able to capture in what time frame. The other thing to really monitor with something like this that I want to understand is, how much capital do they have, and are they going to need to raise capital to accomplish their go-to-market strategy, right? Like if they expect that they can get 10% of that $4 billion market, and they can do 400 million in revenue at a high gross margin revenue, call it 20, 30% operating margins. This would be a very undervalued business. But the question is, can they do that without diluting shareholders and raising a bunch more capital? So I often look at like the growth. I mean, the growth of shares outstanding has already been pretty high. My guess is even just this year from last year, their share count is up 50%. And continues growing through this most recent quarter. So they may have just had some big capital raises, but then the question is, do they have any future capital raises? What's the appropriate share count to use? And so that's a big part of figuring out the valuation of the company today. So I'll take a look at that one later some more. So Spine Hustle's asking, would you position size the Fannie preferred stocks as one position or as three separate positions? And asking also about using the modified Kelly method for position sizing, as I've talked about. Yeah, so I would actually consider these as one position. I mean, because your risks are pretty much the same here. So whether or not you're buying like a different preferred share class, like FNMAT or FNMAS, right? Like if you're FNMAN, we've talked about some of the different share classes, but they're essentially all the same security. So the Fannie, these are all at the same place in the capital structure. So they're the Fannie Mae Junior Preferred Securities. And we'll talk a little bit more about what exactly that means, but these are essentially the same securities. They have slightly different terms, but in a restructuring, they're all going to be treated as the same class. And so they pretty much have, and that's why you see them all trading. So now a couple of these, like I said, have a $50 par value. So those are the ones that you see trading between like 15, 17 bucks. So like FNMAN has a par value of 50. I believe like FNMAH, oh no, not FNMAH. Let's see, FNMAM would be another $50, so that also trades at $16. All the $50 par value prices trade around the same level, and all the $25 par values like FNMAS trades for, $9.80. FNMAT trades for about $9. It actually trades at a slight discount because it's not as liquid as FNMAS. FNMAJ, 860. They're all relatively in the same spot because they're essentially more or less they're going to have the same recovery, the same eventual value. So, I would treat them as one position. So I own, I think 3 or 4 different classes, but I treat them as one position. So for position sizing, let me see if I can pull up my Kelly formula here. Let's see if I've got it here. I don't think I have it here in this email. I'll pull that up. I'll cover the Kelly formula a little bit more in depth in one of the next weekly updates so that we can really dive a little deeper into it and understand the calculation a little bit better. But yeah, and I can also talk a little bit about it in the channel later when I pull my spreadsheet up. I have it in my other email account, which is why I can't pull it up quickly here right at this moment. But the modified Kelly is suggesting, for me, it was actually suggesting I'm actually using, so a lot of times, so the Kelly formula will spit out a number. I'll often use like a half Kelly, which is why, this is a pretty common thing for people that use the Kelly formula. You take a haircut to the percentage that it tells you because of the uncertainty in your assumptions. And so oftentimes I'll use a half Kelly, or the percentage that is half of what the Kelly formula is telling me to use for position size. In this case, I'm actually using slightly less than half because the Kelly formula was telling me to do, I believe it was something like 12% is what the Kelly formula was spitting out. And I'm actually sizing this more like 4 to 5% right now. So that's where I'm at today on position size. And I may go a little higher, but I'm also giving myself a little bit of room to increase the positions should it sell off a little bit more. Because, as you know, these can be illiquid at times, and they can follow news flow and be pretty volatile. So, you've had opportunities along the way there was a big spike here around the Trump election in both the common and the Fannie preferreds. And so, this was a $4 preferred stock that went over 10 and then back down to the 5s at a certain point. So there's some pretty decent volatility on these depending on news flow. And we expect a lot of news flow around these in the next year because not only do we have like the new appointments at the FHFA, but we're going to have probably talks with Congress about the reprivatization. There's going to be plans that are proposed. There's going to be court rulings that are ongoing. A lot of the court ruling stuff is why I got why I redid my calculations and actually increased my bull case upside, because there's some interesting things happening in a couple of the court cases. Essentially with these court cases, you've had a bunch of private investors that owned either common stock and or preferred stock, junior preferred stock, and they're taking the government to court over the way that these things were taken over by the government and the net worth sweep. Basically, the government's been taking all of the earnings out of Fannie and Freddie, and instead of keeping the earnings there and having these entities get healthier by recapitalizing, the government's been taking the money out and using it for their own purposes. And some of the ways that they've initiated that legally are in question. And so these court cases are working their way through various courts. So we're going to have some more court rulings probably this year as well that impact how these securities trade. So there's a lot going on here. And Bo asked which you should buy. I talked about in the Discord channel on the trade alert. There are all these pretty much trade in line today with just slight discounts depending on liquidity, right? So FNMAS is probably one of the most liquid of the Fannie preferreds, and that's why it trades at a slightly higher price. So it trades at $9.80 today. FNMAT, which is more or less the same security, trades at $8.85. Now, both of those, again, my base case is expecting somewhere between $20 and $25 potential recovery in a year or two. So if you're buying at $9.80, you're going to get a slightly lower return than if you're buying at $8.85. But the trade-off is if you're buying FNMAT at $8.85, there's less volume there, there's less liquidity. So you could see more volatility, number one, but also depending on the amount of capital that you're trying to put into the trade, you could move the price a little bit more significantly trying to buy FNMAT versus FNMAS. So it really depends on buying whatever security or whatever preferred stock kind of depends on your level of capital and your tolerance for liquidity. And so, yeah, you could buy FNMAA, but that is a different security. FNMAA is the common stock. It is not the same as the preferred stock. So FNMAA trades for $2.70, and it's part of 1.2 billion of common shares. Now, these are treated completely differently than how the preferred stock is going to be treated. So the common stock will be the last class of stock to get anything in a reprivatization. And we don't know actually if the common stock is going to be part of the recapitalization. We don't know if these shareholders, these FNMA shareholders could get completely wiped out. This could easily go to zero. And the same thing could happen to the junior preferred stocks like FNMAT and FAMAS, but it's less likely to happen to them because the preferred stock has it is higher in the capital structure, which we could do a deep dive in capital structure another time, but suffice it to say that the preferred shareholders are supposed to get paid before anything gets paid to the common shareholders. So in a bankruptcy, that's what happens. Like preferred stock gets paid before common shareholders usually. The other thing about the preferred stock is that they were supposed to be getting dividends over the last few years, but because these were nationalized more or less, their dividends have been suspended, and so they have a claim on past dividends, preferred stock dividends, that the common stock doesn't have. So there's just differences in the actual securities themselves, where they sit in the capital structure, how they will be treated in a bankruptcy or recapitalization. So buying the common stock is not the same as buying the preferred stock. But yeah, we can go more into that later. One of the things that is, I think, worth reading is the Moelis plan. So the Moelis plan was put out by, let's see if we can find it. I want to find the actual, so GSE, Safety and Soundness. Now, I'm not sure that the Moelis plan is truly the right blueprint for how these things are going to get recapitalized, but it is one set of preferred shareholders essentially paid a company called Moelis that does a lot of restructurings to come up with a plan for recapitalization and reprivatization of Fannie and Freddie. And they've posted this plan. So let's pull it up here. You can read through it. This was last updated in November. And they talk about some of the history of what happened, but they also talk about, what they expect needs to happen for Fannie and Freddie to be taken out of government receivership and reprivatized and recapitalized. And so they talk about, for instance, how this is going to work. So they talk about rebuilding capital through ending the net sweep. They talk about raising new equity capital, and they talk about even converting the existing preferred stock, which is what we're talking about here, right? And so you can go through this plan and read through it, Now, it's an interesting blueprint for how a recapitalization might work. I'm not saying that it's even the most likely way that it will work, but in the MOLAS plan, for instance, FNMAA, the common stock, more or less gets wiped out, whereas the junior preferred stock, which is what we're talking about here, does get reinstated around par. So it actually does get equitized into the new entity. So it turns from being a preferred stock in the old entities into common stock in the new entities. And on the valuation that they're proposing, which is somewhere between 200 and 300 billion for the new recapitalized entities, it would have recoveries of about par, or about $25 per preferred share today. So anyway, this, you can take a look at this and go through it. Can be a little bit tricky to understand, but point being, you can see, and they talk about valuation ranges based on valuing it, in a couple different ways, and what the equity offerings could look like, and what that means for the junior preferred securities. And they actually contemplate the government retaining a pretty large ownership in the recapitalized entities. And then a potential share price of what that could look like. So yeah, that's an interesting, if you want to do some homework on it, that's an interesting way to look at it. But it does help you understand too the difference between the preferreds and the commons, and what needs to happen for all of this to go forward. Any other questions out there? One thing I meant to mention earlier is that it's an interesting time for idea generation, because the what we call 13Fs have been coming out. So large hedge funds and asset managers have to file what they call a 13 HFR, and so every quarter, within 45 days after quarter end, a hedge fund has to file what positions they own and how much, at least US based positions. And so I like to follow, there's certain hedge funds that I follow that I think are really sharp, and I always find it really interesting to find out what other smart investors are buying or even selling in that case. So you can see here, Tiger Global is a famous hedge fund run by some really sharp people, especially they do some really interesting things in tech in particular. And I've mentioned before, they actually made a big investment in Fiat Chrysler, which is on our watch list, FCAU. But Tiger had to file their quarterly holdings report they filed it on February 14th, which was essentially one day before the deadline, as most hedge funds do. But you can go in and you can actually look at all of their US based positions, and how much they hold. Like in this case, they own over $1 billion of Amazon. And so you can see the number of shares and the total value as of Q4, as of the end of Q4. So it'd be December 31st, 2018. You can see what positions they hold. And so a better way to actually look at this is their aggregator websites, like Whale Wisdom is one that I like. So Whale Wisdom, their user interface for free customers that don't pay the monthly fee can be a little bit shoddy, but their information is actually good. They just have added ads to their pages. But here's the one we were just looking at. Actually, this is a different one. That's not Tiger Global. It's Tiger Management. So if you pull up Tiger Global in Whale Wisdom, we can see all of their holdings and actually the changes in their holdings. So we can see, actually, if we sort it by market value, Spotify is actually now their largest holding, US-based holding, and they added a few shares. Not a lot of shares this past quarter, but they added a little bit of shares. They added a ton of shares of JD, or not a ton, but they added decently to their JD position. And JD is one on our watch list, and it's one that I'm getting pretty interested in because it hasn't rallied as much as some of the other technology stocks. Part of that's because it's Chinese stock, and Chinese stocks haven't gotten as much love with all the noise coming out of China about economic weakness. But anyway, interesting to see. It's like their third biggest position at Tiger is JD. They own over $1.2 billion of JD stock. FCAU, one of the ones on our watch list, is actually the fourth biggest position, and they had a huge increase in the fourth quarter, which we actually already knew because they, once they get above a certain level, once a hedge fund gets above a certain level of ownership in a stock, they have to file a filing for a single stock. Actually, they have to file what's called a 13G filing, and you can see here they filed a amended 13G filing on Fiat Chrysler on the 14th. They filed their original 13G on it on December 10th. So this was basically indicating that they were a greater than 5% owner of FCAU. So at that point, they owned 5.1% of Fiat Chrysler. So once you get over 5% of a stock, once you own over 5% of a public company, you have to file a 13G or 13D. So we already knew about Fiat, but some of their other smaller positions that they don't file 13Gs on, you can see what they've been doing, what they've been selling, what they've been buying. So they sold some Booking, they bought some Facebook. They actually upped their Facebook position by almost 20% in Q4, which probably did pretty well for them. So anyway, it's interesting because 13F season means we can look at a bunch of different hedge funds that we follow and look and see what they were doing with their positions at the end of Q4. Now, this data is a little bit stale. So if they've done some things with these positions in the last month or two, then, this data could be stale. So we have to, caveat that and just know that. But when you have these hedge funds that have like pretty longer term holding periods like Tiger does, then, it's less likely that they're just going to completely blow out of a position. But occasionally that happens, like here with Alibaba, for instance. They sold a third of their position in Q4. So anyway, it's a poke around on whale wisdom if you're interested in following certain funds. I've got a set of funds that I follow, and as part of the bootcamp course, I'm going to probably release a list of 40 or 50 top funds that I follow for idea generation. Someone asks, Bo asks, if everyone is trying to beat the S&P 500, do we just invest in the index for the long term? Yeah, so we talk about that in the intro videos. I encourage you to go over to the Scale Incubator site and and actually go to the community intro, stock community intro videos. I'm not signed in at the moment, so I could pull that up later. But the intro videos will go through like the difference between active and passive investing. And, passive investing is a good strategy for a lot of investors for stocks that, if they don't want to be active, if they don't want to try to beat the market, then they can invest passively in ETFs, low cost ETFs, and get that, expected probably 7 to 8% annual return. Now, again, that doesn't, that's like an annual average over a long period of time. So you probably want to stay invested and be like a buy and hold investor for the long term if you're following the passive strategy. And again, you can have parts of your portfolio that are passive and other parts that are active. The reason that I choose to be pretty active is because I feel like I have the skill set to beat the market, and I've been able to do about 25% annually in my personal account over the last decade or so. So compounding at that level can dramatically increase your portfolio value. We've talked about this before, but compounding at 20% or 20, even compounding at, say 16%, compounding at double the 8% annual average doesn't give you double the account value after 10 or 20, 30 years. It gives you like significant multiples of what you would have if you had just done the passive approach. So if you feel like you have the skill, if you feel like you have someone like me to help guide you to really compelling investments, then, an active approach can really make sense, especially for certain parts of your portfolio that you are willing to be more high risk with. So it really comes down to your individual situation, but there are merits to active and there are certainly merits to passive as well. Some people believe that, it's just not worth active because they have this idea in mind that it's just tremendously hard to beat the S&P 500. And part of that is because mutual fund managers have been so bad at beating the S&P 500 for a long time. But, I have some serious disdain for mutual fund managers because I just don't think they're very skilled and they don't have the right incentives to be skilled. They're not incentivized to even beat the S&P 500. They're incentivized to market and raise as many assets as they can. So no wonder they can't outperform the index when they're they're buying 200 or 300 different stocks. They're over diversified. They don't even much care about beating the index anyway. And they're just out there trying to gather as much assets as they can. So their incentives are not aligned. And, there are a lot of different reasons that I think that they're, not a good indicator of whether it's possible to beat the index. So yeah, I have pretty strong opinions about that, but I also recognize the value in passive, and I recognize the value in, different individual situations. All right. Well, I don't see anything else as far as Q&A right now. So I think it's probably a good time to wrap it up, and we'll follow up on some more stuff later this week that we've talked about earlier. So enjoy the week. We'll have a lot more exciting equity trades in the coming weeks. So cheers, everyone, and have a good one.